Auto sales, which are witnessing a slowdown not only in India but across the world. Economic factors coupled with tighter regulations and emission norms are taking a toll on automakers, and that in turn is hurting equipment manufacturers as well, with muted demand for vehicles. There are not many takers for auto parts then. Mahantesh Sabarad of SBICAP Securities joins us right now on the show to discuss about the possible pulls and pressures on these parts going ahead. Mahantesh, good having you. Thanks for joining in. The common conversation or a rhetoric that I heard from a lot of people, Mahantesh, was that while autos may see a slowdown because of the replacement market which exists in addition to the OEM market, auto ancillaries would be relatively unscathed. Is that a reasonable assumption, or do you think even that will get challenged if both the local and the global markets, auto markets, continue with this slightly moribund kind of performance?
Good morning, Neeraj. That's a good question. Yes, when you look at the auto ancillary space, I do believe that the assumption that you make on the replacement side is a reasonable assumption. Because if you look at the auto component industry, there are three things actually that they are catering to, three different sets of markets that they are catering to. One is the OE, domestic OE maker. They also have the replacement market to cater to, and the third is that they have significant exports either out of India or out of their factories that they have set up abroad. So from all these markets point of view, for an auto ancillary, the business is not only diversified, the opportunities depending on what strategies you employ is immense.
Okay. So, Mahantesh, do you think this either fundamental comes sentimental negative overhang that stays on the auto ancillary companies right now stays? I mean, some high quality names which have delivered consistent return ratios and the earnings growth over the last few years are trading at 52-week lows at least, if not lower. I mean, essentially maybe multi-month lows as well. What gives here and what happens to each of these? Because I think there's different horses for courses for a Jamna Auto versus a Motherson Sumi versus some of the others. Different factors impact them. But how do you look at this factor?
So you're right, sentiment is actually playing a large part in the way the stocks have performed, particularly this fiscal year. In the auto ancillary space. When I look at collectively some 30 odd auto ancillary companies, which is what we tend to observe most of the time, is that for the 9-month period this fiscal, if the profitability for collectively for these auto ancillaries has grown by something like almost 20% or 19.5 thereabouts. At the same time, the median stock performance in the same period is roughly about 20% down. So it's really, a paradox here. One hand, your profitability growing 20%, on the other hand, stocks actually falling 20%. So somewhere it is more of sentiment that is playing onto these stocks. A few, like you have said, are trading near 52-week low. Some of them have collapsed almost 50%, even at a time when the delivery in terms of its profitability is consistently there. I can sort of single out a couple of companies here. LG Balakrishnan, for example, LG Bros as it is known, has delivered in terms of profitability consistent growth, yet the stock has just collapsed this year and the valuation has become far too reasonable. It is perhaps around 13x in terms of P valuation. So you have such examples, but then at the same time you also have examples where some stocks have consistently done well. Gabriel is a standout here, or an Endurance Tech is another company which is a standout in terms of performance, stock performance.
Mahantesh, obviously, while primarily the outlook for the auto ancillaries depends on the outlook for the auto segment as a whole, is there any factor that one can, look at, even if we have to keep in mind in anticipation that the auto industry will start to pick up, but for an investment case at this point in time, if there is one or two factors, primarily from the auto ancillary side, that you have to look at to make an investment call, what would that be?
So, we look at companies which has significant replacement market potential. Okay, so that's one strategy that we can't ignore. So naturally, there are subsegments within auto ancillaries which therefore become our favorite sort of hunting ground. Tires is one of them, batteries is another one, and some other components as well. These are companies that we really look for. The second thing that we look for is the management quality of these companies and the track record. Some of these companies are very old. They are like in the business for decades. And therefore management quality and track record is something that we look at. And third, we try to figure out, is there structurally anything that is happening which is either favoring them in terms of their profitability ahead or depressing their profitability. So when I named batteries, for example, while it becomes for us a favorite hunting ground because there is huge replacement demand, structurally their margins have never moved up, or they have been subdued, and therefore the stocks have not done well. And there was a brief period a couple of years ago when the battery stocks were favorites of the markets, and therefore the valuations went above average, overshot comfort zone. So you have to look at these things, and a combination of growth versus valuation is the classic theory that we will look at after doing these initial analysis.
Okay. Mahantesh, so based on the numbers and the whole assessment that you've done, is there a name that gives you a good bang for the buck right now? The stock may well do what it does. It may well drift lower as well because the sentiment might be bad. But to your assessment, the numbers and the quality of or the return ratios and the other factors work in favor of making an investment even in these troubled times.
So let me single out two stocks. One is a very large cap stock within the ancillary space. The largest one is Bosch right now in terms of market cap. I think upwards of 40,000 crores or thereabouts. And there is a very small stock whose market cap is barely 350 odd crores. Both these companies are something that we think, as you put it, can give maximum bang for your buck. The largest auto ancillary that I talked of is Bosch. Now, Bosch, in terms of valuation, mind you, is very expensive. One of the most expensive stock, not just in terms of it's just stock price alone. In terms of P multiples, it is somewhere around 35 in terms of valuation. But that 35 multiple is a cheap multiple that you're paying for a solid management quality with great future. Technologically very innovative and sound kind of company, and who has given, mind you, this financial year has on an EBIT basis grown its EBIT close to 26%, not times. So here is the company which has given growth in profitability, has a great future ahead. It's only sentimentally that the stock has not done well so far. So that's one. On the other side, we have an outstanding call on PPAP Automotive. PPAP Automotive is like a virtually a small Motherson Sumi in terms of its business, the kind of business that they do. They're into plastic parts essentially, and here its valuation multiples are like almost in single digit, 9 times its future earnings. So P multiple is low, market cap is very low, growth is substantial because now they are diversifying away from Maruti. Maruti was their mainstay customer. Now they are getting into other customers including Honda, which is the Honda motorcycles. And here is a stock which has in the past sort of 1 year has collapsed almost 50%, has become half. I think where you have growth, and this is a company which has also delivered growth on the EBIT basis in the 9-month period, close to 20%. It's not as large as 26% of Bosch. So these are the companies that one can really single out, and there are a couple of others. Like I said, consistent stock performance and consistent delivery on profitability has come from Gabriel and an Endurance Tech, of which Gabriel we have an outstanding call.